March 2025, Tehran. There's a number taped to the glass of a small exchange shop, written in marker like a warning. 1,039,000 reals per US dollar. A man in a work jacket stands there doing something that looks ridiculous until you realize it's perfectly rational. He isn't buying dollars to travel. He's buying dollars to stop time from stealing his paycheck. Because the strangest part of currency collapse isn't just that prices rise, it's that time speeds up. The math updates faster than your emotions can. The clerk checks his phone, scribbles, replaces the paper. Not by much, but everyone feels it, like the floor moved half an inch. Outside, a grocer doesn't price tomatoes anymore. He prices replacement. If I sell this today, his face says, can I buy it back tomorrow? No bombs, no sirens. Just invisible constraints tightening around a country's money until it becomes a melting ice cube in someone's hand. This isn't fiction. This happened. And look, I spend an unhealthy amount of time reading old crisis reports, currency charts, and legal notices because I don't like being surprised by predictable disasters. Sanctions are one of the most predictable because they don't need to explode a currency. They quietly break what the currency can do. So here's the question that matters. How do sanctions destroy a currency without a dramatic day it dies? By the end of this, you'll understand the repeatable machine, and you'll have a simple watch list for spotting the pattern early. Not ideology, incentives, constraints, plumbing. Because money isn't magic. Money is a claim on goods, energy, parts, shipping, insurance, credit, and trust. Sanctions squeeze those channels first. The currency just takes the blame later. Here's the pattern. Collapse looks chaotic from the outside. From the inside, it moves in 5 beats, and once you see them, you start noticing the same rhythm everywhere, like hearing the same song in different languages. Beat 1, dependence. A country relies on imports it can't replace, or exports it can't lose. It feels normal until it doesn't. How many months of essentials can you run on normal if the pipes slow down? Beat 2, the plumbing shock. Sanctions don't have to ban everything. They can squeeze banking access, payments, trade finance, shipping, insurance, licensing. The system still exists, it just starts stalling. Paperwork multiplies, partners hesitate. Everyone suddenly needs legal review. You know, the kind of phrase that kills deals without saying no. Beat 3, hard currency scarcity. Importers need dollars to restock. Families want dollars to protect savings. Businesses need dollars to settle bills, but inflow drops. Now the exchange rate becomes a battlefield. And tell me, what do you do when your money can't reliably turn into what you need? Beat 4, the shadow price. A parallel market becomes the real market. Stores price by replacement cost. The official rate turns into paperwork. The public learns a brutal lesson. The legal price is not the real price. Beat 5, the cage. Controls arrive to trap value, limits, forced conversions, surrender rules, crackdowns. The goal is stability. The result is a 2-tier economy and a quiet vote of no confidence. And here's the trick. A currency can look stable under tight controls. That doesn't mean it's healthy, it can mean it's sedated. Now case files. Different decade, same skeleton. Case file 1, Yugoslavia, early 1990s. Trade gets choked. Hard currency inflow collapses. The state still has bills. Wages, pensions, subsidies. So it patches the gap the oldest way. It creates more money. Let's do the math. Fewer imported goods arrive. More local currency chases what's left. Prices jump. Then people stop treating money as savings and start treating it as a hot potato. You spend today because tomorrow is a haircut. That accelerates velocity, which accelerates inflation, which destroys trust. And the loop tightens. Who gets destroyed? Anyone paid in fixed local claims. Salaries, pensions, deposits. Import-dependent businesses without privileged access to hard currency. Who adapts? Anyone with outside currency, export income, or a way to convert wages into real goods immediately. Rule: if trade is choked and budgets stay alive, the printing press becomes a bloodstream. Case file 2, Iran, multiple waves. When sanctions target banks, energy revenue channels, and reserve access, the country's money loses a critical feature: convertibility at scale. Even when certain goods are allowed, trade still needs financing, insurance, shipping, settlement. Allowed can still mean hard. Inside the country, the squeeze looks simple. Everyone needs hard currency, and fewer sources can provide it. Importers need dollars for inventory. Families want dollars for tuition and medicine. Companies need dollars to service obligations. Meanwhile, inflow faces obstacles: restricted exports, blocked payments, bigger discounts, and fear in the banking system. So the central bank faces ugly choices: let the currency fall and accept inflation, or defend it by burning reserves and tightening controls, which pushes activity into the shadow market anyway. It's like trying to hold water in your hands by squeezing harder. Rule: when hard currency becomes scarce, Everything gets repriced as a proxy for it. Case File 3, Russia 2022. This one matters because it shows how people get fooled. A currency can crash, then recover, and the headlines scream, "Sanctions failed." But exchange rates aren't a scoreboard. They're a clearing price, and you can change the clearing pool. Raise rates, restrict conversions, limit outflows, require exporters to sell foreign currency, compress imports so fewer dollars are demanded. In a controlled pool, that can mechanically support the official rate, even while real choices shrink and the economy absorbs damage. So ask the only question that matters. Does a stronger official rate mean more real access to goods, parts, and options? Or just tighter rules? Rule: a currency can be strong while the country gets poorer in real options. Now zoom out. What tends to survive and what tends to get wiped out when sanctions push a currency into decay? I'm not giving you a shopping list. I'm giving you mechanisms. Honestly, if this sounded like 5 easy tricks, you should click off immediately.